Stop scrolling. Close that Fed meeting summary you're analyzing. Turn off the financial news explaining transitory policy adjustments. Because what I'm about to tell you changes everything you think you know about monetary policy and dollar dominance. The Federal Reserve isn't cutting rates to stimulate the economy. They're cutting rates because they have no other choice. And if this is true, the dollar's reserve currency status cannot survive. Ladies and gentlemen, what happened in the last Federal Reserve meeting represents the most dangerous monetary policy trap since the 1970s stagflation crisis. But this time, it's not about inflation getting out of control. It's about the complete loss of policy credibility. It's about a central bank that has painted itself into a corner where every decision accelerates the destruction of the currency they're supposed to protect. Here's what everyone thinks is happening. They think the Fed is conducting normal monetary policy management, cutting rates in response to economic data, following the dual mandate of price stability and maximum employment. The mainstream narrative suggests this is routine central banking designed to achieve a soft landing for the economy. That narrative is fatally flawed and systematically misleading. Because while financial media focuses on employment data and inflation targets, something far more catastrophic is occurring behind the veneer of professional monetary management. The Federal Reserve isn't managing economic cycles. They're managing an existential crisis. This isn't monetary policy. This is currency preservation, emergency measures disguised as normal central banking. Let me walk you through what actually happened when the Federal Reserve cut rates to the 3.50%, 3.75% range in December 2025. The decision was not based on economic optimization. It was based on mathematical necessity, driven by debt dynamics that have reached unsustainable levels. The United States government now spends over $1 trillion annually just on interest payments for existing debt. That's not principal repayment. That's not infrastructure investment. That's not defense spending. That's purely the cost of servicing debt that already exists. At current interest rate levels, debt service consumes more than 25% of total federal revenue. Translation, the U.S. government cannot afford normal interest rates without triggering immediate fiscal crisis. But the rate cuts create an even more dangerous dynamic. Every reduction in interest rates weakens the dollar relative to other currencies and alternative assets. Every reduction makes U.S. Treasury bonds less attractive compared to foreign government debt or hard assets like gold. Every reduction accelerates the flight from dollar-denominated assets that the Fed desperately needs foreign investors to continue buying. This creates what economists call a policy trap. The Fed cannot raise rates without bankrupting the government through unaffordable debt service. The Fed cannot lower rates without destroying demand for the currency and government bonds that fund the debt. They are trapped between fiscal insolvency and currency collapse, and they chose currency collapse. The December rate cut wasn't economic management. It was an admission that fiscal concerns now override monetary policy independence. The Federal Reserve officially subordinated currency stability to government financing needs. They chose to preserve government spending capacity at the expense of dollar purchasing power. But here's where the crisis accelerates beyond traditional policy mistakes. Because the rate cuts that were supposed to provide fiscal relief are actually accelerating the conditions that make fiscal relief impossible. Foreign investors holding U.S. Treasury bonds are experiencing negative real returns when adjusted for currency depreciation. The dollar has weakened by over 10% in 2025, which means foreign holders of U.S. debt have lost money even after receiving interest payments. They are being paid 4% interest while losing 10% to currency debasement. China, Japan, and European central banks are responding predictably. They are reducing their holdings of U.S. Treasury bonds and increasing their allocations to gold, hard assets, and alternative currency reserves. This creates a feedback loop that forces the Fed into even more accommodative policy to compensate for reduced foreign demand. Less foreign buying means the Fed must purchase more government debt directly through quantitative easing programs. More quantitative easing means more dollar creation. More dollar creation means further currency weakness. Further currency weakness drives more foreign selling. The cycle reinforces itself until something breaks, and something is breaking right now. J.P. Morgan Global Research just released updated gold price forecasts that confirm what currency markets are already pricing. They expect gold to reach $5,000 per ounce by the fourth quarter of 2026, with potential for $6,000 per ounce in longer-term scenarios. These aren't speculative price targets. These are mathematical projections based on continued Fed policy accommodation and dollar debasement. Let me explain the calculation methodology that supports these forecasts. J.P. Morgan analysts are modeling gold prices based on central bank diversification patterns, ETF demand flows, and currency debasement expectations. Their base case assumes continued Fed rate cuts, sustained government deficit spending, and accelerating foreign dollar reserve reduction. The $5,000 gold target isn't based on crisis scenarios or geopolitical shock assumptions. It's based on the continuation of current monetary and fiscal policies. If the Fed maintains accommodative policy to support government financing, and if foreign investors continue reducing dollar exposure, gold mathematically reaches $5,000 based on historical relationships between currency debasement and hard asset pricing. But the $6,000 upside scenario becomes realistic if Fed policy accommodation accelerates or if foreign dollar dumping intensifies beyond current trends. This isn't hyperinflation forecasting. This is currency substitution mathematics applied to a reserve currency losing its monopoly status. Central banks worldwide are already positioning for this transition. Official sector gold purchases have exceeded 1,000 tons annually for 3 consecutive years, with 2025 marking the 4th consecutive year above this threshold. The World Gold Council reports that central banks purchased approximately 220 tons of gold in the third quarter of 2025 alone, representing a 28% increase from the previous quarter. These purchases aren't occurring because central banks expect gold to outperform as an investment. They're occurring because central banks are systematically reducing their dependence on dollar-denominated reserve assets. They see the same policy trap that JP Morgan analysts are modeling, and they're positioning their reserves for a world where dollar dominance continues eroding. Russia has announced plans to add silver to state reserves alongside existing gold accumulation programs. Saudi Arabia has disclosed silver ETF positions in SEC filings, marking the first time the kingdom has publicly reported precious metals exposure beyond traditional gold holdings. Even smaller nations are exploring strategic metal reserves as hedges against currency debasement and financial sanctions. This represents unprecedented coordinated movement away from dollar reserves toward physical asset reserves by sovereign entities. When central banks collectively abandon currency reserves in favor of commodity reserves, it signals fundamental loss of confidence in the reserve currency system itself. The Federal Reserve sees this happening, but they cannot respond without triggering the fiscal crisis they're trying to avoid. Raising rates to defend the dollar would immediately increase government debt service costs beyond sustainable levels. Maintaining current rates allows continued foreign reserve diversification, but prevents immediate fiscal crisis. They chose the slow-motion currency crisis over the immediate fiscal crisis, but slow-motion currency crises have a tendency to accelerate once confidence breaks. Now let's examine the mathematical constraints that make Fed policy reversal impossible under current fiscal conditions. The Congressional Budget Office projects federal debt reaching $45 trillion by 2028 under current spending trajectories. At a 5% average interest rate, annual debt service would exceed $2.25 trillion, consuming nearly half of total federal revenue. The government would face a choice between defaulting on debt obligations or eliminating most discretionary spending, including defense, education, and infrastructure investment. Neither option is politically or strategically acceptable, which means the Fed must keep interest rates artificially low regardless of currency consequences. This creates what bond market analysts call financial repression, a policy regime where interest rates are held below inflation rates to reduce the real burden of government debt. Savers and bondholders lose purchasing power to subsidize government borrowing. Currency holders experience gradual confiscation through debasement. But financial repression only works if investors cannot easily substitute into alternative assets. In previous financial repression periods, gold ownership was restricted, foreign currency access was limited, and alternative investments were heavily regulated. Today, investors have unprecedented access to hard assets, foreign markets, and digital alternatives that bypass traditional financial controls. This makes current financial repression unsustainable because capital can escape the debasement tax through asset substitution. When investors substitute out of currency and bonds into gold, real estate, and foreign assets, it accelerates the currency weakness that financial repression was designed to manage gradually. The Fed is attempting financial repression in an era when financial repression cannot work due to capital mobility and asset availability. The policy will fail faster than historical precedents because the escape mechanisms are more accessible and the stakes are higher. Federal Reserve Chair Jerome Powell's term expires in May 2026, adding additional uncertainty to already unstable monetary policy dynamics. Early indications suggest the successor may adopt even more accommodative policies in response to economic weakness or financial market stress. A more dovish Fed leadership would accelerate the currency debasement timeline by removing remaining constraints on money creation and debt monetization. This would push gold price targets higher and accelerate the timeline for reaching $5,000 per ounce from fourth quarter 2026 to potentially mid-2026 or earlier. But even if Fed leadership becomes more hawkish and attempts to defend the dollar through higher interest rates, the fiscal constraints make sustained tightening impossible. Government debt service costs would force a reversal within months, creating even more dramatic policy whipsaws that destroy remaining central bank credibility. The Fed is trapped regardless of leadership changes. The fiscal mathematics overwhelm monetary policy independence under any scenario where government spending remains at current levels relative to revenue. Meanwhile, the real economy is already adapting to dollar instability through accelerating adoption of alternative value, storage, and exchange mechanisms. Corporate treasuries are increasing allocations to hard assets, precious metals, and foreign currency deposits as hedges against dollar debasement. Tesla, MicroStrategy, and other major corporations have established significant Bitcoin and gold holdings as alternatives to cash reserves. Apple, Google, and Microsoft are negotiating supply agreements denominated in non-dollar currencies to reduce exchange rate exposure. Even traditional companies are exploring barter arrangements and commodity-backed contracts to avoid dollar intermediation. This corporate dollar avoidance accelerates the velocity decline that reduces demand for dollar-denominated assets. When corporations minimize dollar holdings and foreign trade occurs through alternative currencies, it reduces the international demand that supports dollar exchange rates and treasury bond markets. Individual investors are responding similarly through increased allocation to precious metals, real estate, and foreign assets. Gold ETF holdings have increased for 11 consecutive months, while silver ETF inflows have turned positive after nearly 2 years of outflows. Retail investor demand for physical precious metals has reached levels not seen since the 2020 crisis. But the most significant shift is occurring in fixed income markets, where traditional bond investors are discovering that government bonds no longer provide protection against currency debasement or inflation. The 60-40 portfolio allocation model assumes that bonds appreciate when stocks decline, providing portfolio balance and downside protection. This relationship is broken down as stock-bond correlations have reached 30-year highs. When currency debasement accelerates, both stocks and bonds decline simultaneously as investors substitute into hard assets that maintain purchasing power. Traditional portfolio diversification stops working when both financial assets are denominated in a depreciating currency. Investment advisors are restructuring client portfolios to include significant precious metals allocations as replacements for portions of traditional bond holdings. The institutional investment flows into gold and silver are just beginning, as portfolio managers recognize that currency debasement makes traditional fixed income unsuitable for wealth preservation. This institutional reallocation creates sustained buying pressure that supports JP Morgan's $5,000 gold target beyond speculative demand or crisis-driven safe haven flows. When pension funds, insurance companies, and sovereign wealth funds systematically increase precious metals allocations from current levels near 1 to 2% to more appropriate levels of 10 to 20%, the demand flow sustains higher prices for years. The timeline for this institutional reallocation is already visible through ETF flow data and central bank purchase patterns. Gold ETF holdings increased in 11 of 12 months during 2025, while central bank purchases maintained elevated levels despite higher prices. This suggests institutional demand is price inelastic and will continue regardless of short-term price volatility. Silver markets are experiencing even more dramatic institutional interest due to the metal's dual role as monetary asset and industrial commodity. Industrial demand from solar energy, electric vehicles, and artificial intelligence infrastructure creates a demand floor that supports prices independent of monetary factors. But the monetary demand is accelerating as investors recognize silver's leverage to gold price movements combined with supply constraints that don't exist in gold markets. Silver mine production has declined, while industrial consumption has increased, creating structural deficits that persist even at current elevated prices. The combination of monetary debasement demand and industrial supply constraints positions silver for price appreciation that could exceed gold's percentage gains over the next several years. If gold reaches $5,000, $6,000, historical silver to gold ratios suggest silver prices of $150, $300 per ounce. But these price targets assume orderly currency debasement and gradual institutional reallocation. If Fed policy accommodation accelerates, or if geopolitical tensions trigger rapid foreign dollar dumping, precious metals could appreciate much faster than current institutional forecasts suggest. The key risk factor is confidence breakdown rather than gradual policy evolution. Currency crises typically develop slowly, then accelerate rapidly once confidence thresholds are breached. The dollar maintains reserve status through institutional inertia and network effects, but these advantages disappear quickly if alternative arrangements become available and attractive. China's development of digital yuan infrastructure, BRICS nations' exploration of alternative payment systems, and European discussions about reducing dollar dependence all represent systematic challenges to dollar network effects. If these initiatives reach critical mass, dollar demand could decline faster than Fed policy accommodation can compensate. This creates asymmetric risk where gradual dollar decline is the base case scenario supporting $5,000 gold, but rapid dollar decline becomes increasingly probable as alternatives develop and confidence erodes. The upside scenarios for precious metals, are much larger than the downside scenarios under current policy trajectories. Smart money is already positioning for this asymmetric risk profile through precious metals, allocation, foreign asset diversification, and real asset concentration. They recognize that Fed policy constraints make currency weakness inevitable, while fiscal constraints make policy reversal impossible. The retail investment community is beginning to understand these dynamics as dollar weakness becomes visible through higher prices for imports, energy, and commodities. When currency debasement translates into visible cost of living increases, political pressure builds for policies that appear to address inflation but actually accelerate the underlying currency problem. Tariffs, price controls, and fiscal stimulus all provide short-term relief from inflation symptoms while worsening the monetary conditions that create inflation. This creates political economy dynamics that make sound monetary policy even more difficult to implement and sustain. The Fed is trapped not just by fiscal mathematics, but by political incentives that reward policies appearing to fight inflation through means other than currency stabilization. This political constraint makes the currency debasement scenario more probable, and the timeline shorter than purely economic analysis would suggest. Gold at $5,000 per ounce isn't a prediction based on crisis scenarios or speculative bubbles. It's a mathematical projection based on continued implementation of policies that are politically necessary but economically destructive. The Fed cannot escape the trap without triggering immediate fiscal or political crisis. They will choose gradual currency crisis over immediate political crisis. Gold investors who understand this dynamic are positioned for the wealth preservation opportunity of a generation, while dollar holders face systematic purchasing power destruction that accelerates as policy accommodation continues. The trap is set. The timeline is confirmed, and the targets are mathematical rather than speculative. This is not investment advice, but it is monetary reality that cannot be ignored or wished away through policy rhetoric or financial media narrative management. The dollar's reserve currency status depends on foreign confidence in U.S. fiscal sustainability and monetary policy credibility. Both have been subordinated to short-term political expediency. The consequences are predictable, and the timeline is accelerating. Position accordingly. But let me show you the specific mechanism making this Fed trap inescapable. It's not just debt service costs. It's complete breakdown of monetary transmission mechanisms that central banks rely on to influence economic activity. Traditionally, when the Fed cuts rates, lower borrowing costs, stimulate investment and spending, increasing employment and growth. This depends on banks willing to lend and borrowers willing to borrow. But current cuts occur when banks restrict lending due to commercial real estate losses and regulatory requirements. Lower Fed rates aren't translating into lower borrowing costs because credit risk premiums expand faster than Fed rates decline. Rate cuts aren't stimulating real economic activity. They're only inflating financial asset prices and weakening currency. The Fed destroys the dollar to achieve effects that aren't occurring in the real economy. The commercial banking system is broken as monetary policy transmission. Regional banks are insolvent due to commercial real estate exposure. Large banks hoard capital for regulatory requirements. Neither expands lending despite Fed accommodation. Banking dysfunction means the Fed must provide more accommodation to achieve stimulative effects, accelerating currency debasement while failing to address economic weakness. They're trapped, where each response creates worse conditions, requiring more aggressive responses. Meanwhile, international monetary systems adapt to dollar instability, reducing demand for dollar reserves. Central banks establish bilateral swap agreements bypassing dollar settlement. China and Russia expanded ruble-yuan trade. India and Iran use rupee-rial settlement. European countries explore euro-based platforms, reducing dollar intermediation. These systems scale rapidly once established. When major transactions occur outside dollar settlement, it reduces international demand supporting exchange rates. The Fed cannot prevent this through domestic policy. U.S. accommodation actually accelerates alternatives by making dollar holdings less attractive. This creates strategic dimensions beyond fiscal constraints. Even if the U.S. reduced spending, international systems adapt to reduced dollar dependence in ways difficult to reverse. Network effects supporting dollar dominance erode as alternatives prove viable. Once governments develop commerce without dollar intermediation, they maintain fewer dollar reserves. This makes Fed policy less effective while making currency debasement more probable. The Fed loses domestic effectiveness and international influence simultaneously. Gold market dynamics reflect systematic breakdown of dollar arrangements. Central bank purchases are not just diversification, but preparation for post-dollar systems, where gold serves as neutral reserve asset. Central banks accumulating gold build infrastructure for trade settlement independent of U.S. policy. This creates scarcity, supporting higher prices, while reducing demand for dollar reserves, funding U.S. borrowing. The $5,000 target reflects transition toward gold-based diversification. As central banks reduce dollar reserves from 60% toward balanced allocation, including 20 to 30% gold, mathematical demand overwhelms supply. Silver benefits dramatically because markets are smaller. When institutional demand shifts toward precious metals, silver experiences greater volatility and larger moves due to size constraints. Industrial demand creates additional support. Solar energy, electric vehicles, and data centers require silver inputs that cannot be substituted, creating demand floors preventing declines. Corporate treasuries explore precious metals as alternatives to cash management losing purchasing power. Technology companies evaluate hard asset allocation to preserve value. Central bank buying, institutional flows, and retail demand create multiple sources, supporting JP Morgan's $5,000 gold target while positioning silver for larger gains. Mathematical inevitability, created by Fed constraints, means every policy option accelerates debasement or creates conditions making debasement unavoidable. They cannot raise rates without fiscal crisis. They cannot maintain rates without accelerating foreign dumping. They cannot lower rates without destroying credibility. Every path leads to weakness. This isn't speculation. This is analysis of constraints, eliminating options except managed debasement. The Fed chooses gradual destruction over immediate crisis. Investors understanding this position for wealth preservation through precious metals. Maintaining purchasing power during debasement requires assets that cannot be debased through policy. Gold and silver cannot be printed or created electronically. Supply is constrained by mining production, responding slowly to increases. Demand is supported by debasement accelerating as constraints tighten. The Fed trap isn't theoretical. It's current reality determining strategy for wealth preservation during transition from dollar dominance toward alternatives. This is monetary history unfolding. The question isn't whether debasement accelerates. The question is whether you position correctly for wealth transfer accompanying transitions. The trap is confirmed. $5,000 target mathematical timeline accelerating.